For week 6, and just as a reminder, the reading assignments are Chapter 13 and corresponding to the text chapters assigned, the supplemental treatment provided by the Notes to Syllabus document. You don't have to hand in the following assignment, but you are expected to work through the Chapter 13 end of chapter technical questions and even numbered application questions to ensure thorough preparation for the examination that will be administered. As you know, the text provides solutions to the previously identified even-numbered questions, so you can readily check to see that you're on the right track when addressing these questions. As part of the weekly assignment, remember you should select and be prepared to discuss a current business or economic event, reported or analyzed by a prominent national publication, that reflects the relationship presented by the reading assignment. Our focus this week will be on the role of the Federal Reserve, the U.S. Central Bank. Created by an act of Congress in 1913, three of the major functions performed by the Fed are conduct of U.S. monetary policy, supervision and regulation of financial institutions, and execution of the payment system. The chairman of the Federal Reserve, currently Jerome Powell, is nominated by the President and confirmed or not confirmed by the Congress. In its conduct of monetary policy, the Fed is charged by Congress with simultaneously fulfilling two policy objectives. These two major policy objectives direct the Fed to implement a level and growth rate of the nation's money supply, consistent with both price stability and high levels of employment. These two policy objectives can be in conflict with one another, which explains why the Fed's monetary policy decisions can be exceedingly difficult at times. Often, although not always, there is a trade-off relationship known as the Phillips curve between the goals of price stability and high levels of employment. The Fed has three basic tools at its disposal that can be used to alter the level and growth rate of the nation's money supply: open market operations, reserve requirements, and the discount rate, with open market operations representing the primary and common tool by which the money supply is adjusted. If the Fed wishes to contract the money supply, it will sell U.S. Treasury securities in the open market, using as an intermediary what is known as primary government securities dealers. These primary government securities dealers have demand deposit accounts at depository institutions. So when these primary government security dealers purchase the U.S. Treasury securities sold by the Fed, payment for the transaction is implemented via an electronic transfer of funds. This transfer of funds to the Fed reduces demand deposit balances on the books of the depository institutions and thus reduces bank reserves. As a consequence, the supply of bank reserves has fallen in relation to the demand for bank reserves. Consequently, we would expect upward pressure to be exerted on the price of these bank reserves. The price of these bank reserves is known as the Fed funds rate, that is, the overnight cost of depository reserves. Depository institutions are required to maintain reserve requirements against a variety of liabilities, such as checking and savings accounts on their balance sheets. As a point of information, the current target range the Federal Reserve has set for the Fed funds rate is 2.25% to 2.5%. To assist in counteracting the last U.S. recession and to promote ongoing recovery from this recession, the Fed's target range for Fed funds was set at 0% to 0.25% from December 16, 2008 to December 16, 2015. If the Fed wishes to expand the money supply, it will purchase U.S. Treasury securities in the open market, and the process previously described will work in reverse. By way of example, and for insight into how the Fed's monetary policy actions are integrated into the U.S. financial system, let's suppose the Federal Reserve decides that the banking system should have the ability to make more loans. It, that is the Federal Reserve, can increase the amount of reserves in the banking system. To do so, the Fed can purchase, let's say, $1 billion worth of U.S. Treasury bonds in the open market. We'll assume commercial banks hold these U.S. Treasury bonds as assets on their collective balance sheets. When the purchase transaction is completed, the banks lose $1 billion worth of U.S. Treasury bonds, which the Fed now owns, and gain $1 billion worth of bank reserves. Since the bank's deposits have not changed, but their reserves, now excess reserves, have increased by $1 billion, they now can make loans and, in the process, create money. Here's how the money creation process works. Say you wish to obtain a $50 loan from a bank that has excess reserves at its disposal. The bank determines that you are creditworthy and approves the loan. In order for you to be able to access the proceeds of this loan, however, the bank must make these funds available to you in a form you can access. To do so, the bank electronically credits your demand deposit, namely your checking account, in the amount of $50. Demand deposits are a component of the monetary aggregate known as M1. So when the bank credits your demand deposit account in the amount of $50, it has just created $50 worth of money. In other words, the money supply is increased by $50. Note that the loan the bank has made to you is not a component of the money supply. The bank loan is recorded on the bank's books as an asset, principal that you owe the bank. And for you, this $50 is your liability to the bank. The $50 worth of funds the bank has credited to your demand deposit account is recorded as a bank liability. The process, however, does not stop at this point. You go down to your local grocery store and spend the $50 your bank loaned to you. You write a check for this amount. Assume your grocery store deposits this $50 check in its demand deposit account held at a second bank. When your check clears, the grocery store's demand deposit account rises by $50. The grocery store's bank gains reserves and demand deposits, a bank liability, in the amount of $50. Your bank's reserve assets and demand deposits fall by $50. Let's assume that the grocery store's bank was in reserve equilibrium prior to its receipt of the funds corresponding to your check. Assuming a 10% reserve ratio, that is, at least 10% of reserves must be held against deposit liabilities, the grocery store's bank now has $45 worth of excess reserves and now decides it wishes to make a loan in the amount of $45. Once again, to make the proceeds of this loan available to its borrower, it must credit the borrower's demand deposit account in the amount of $45. In so doing, the grocery store's bank has created $45 worth of money. The process, known as the money multiplier process, can continue until $500 worth of new money has been created. $50 divided by a reserve ratio of 10%.